Mona Mahajan is with us, U.S. investment strategist at Allianz Global Investors. We have a big week ahead. It's great to see you. Thanks for being here. So key. We had a nice run on Friday, right, of course, but now this is the big week. I mean, there's so much on the agenda. What are you thinking?
So, generally we think the backdrop right now is benign for risk assets. You have inflation that's low, you have interest rates that are pretty low, supported by the central bank easing not only in the U.S., but globally. And then we have this economic picture that seems to be stabilizing, although yet to be completely confirmed. But in this backdrop, risk assets can grind higher.
So the risk assets can ride higher. So when you talk about trying to navigate this environment, I saw for equities, you say with a barbell approach, fixed income, hunt for yields, just to name a few ideas. So what are the ways to navigate through this? And then I want to go into some of the details of what's really going on. But when we talk about an investment portfolio, how do people do this? What's the best bet?
Yeah, I think for 2020, when we think about U.S. versus global equities, we actually see the case for global equities looking more and more interesting. They have some room for catch-up. They do have some yield for those investors hunting for yield. And also, if the global economy recovers, cyclical sectors can do better, and European and Asian equities are more exposed to those cyclical sectors. So that's definitely one theme we're seeing emerge. Within fixed income, that hunt for yield also brings us to Asia and parts of Europe. But more importantly, we like U.S. fixed income as well.
Well, there's less geopolitical risk, right? I mean, are you factoring that in?
Yeah, certainly two of the biggest overhangs this year, Brexit and U.S.-China trade. Both of them have thawed, we are saying. They have not completely gone away. There is still uncertainty around both, but we're seeing the direction of travel a little more positive. December 15th, as you highlighted, will be a big date. Those tariffs are consumer-focused, and we don't want to hurt the consumer at this stage in the cycle right now. So.
Well, the other thing, too, is that we have very accommodative Fed this year, right? Absolutely. I mean, we have a Fed meeting this week. Your thoughts on the Fed meeting?
Yeah, look, they've done 3 rate cuts this year. I think that was great. They've implemented what they're calling a mid-cycle adjustment, which has supported risk assets broadly. Usually we get a lag impact from those rate cuts 6 to 12 months down the road. So what we're seeing now is they're on hold. They've indicated that the bar will be pretty high, both for additional rate cuts, but also for additional rate hikes. So unless there's a material deterioration in the outlook, we think they're on hold.
What about the fact that we're seeing just other things such as the repo, exposure, the liquidity that they're providing? It's amazing. It's oversubscribed going into the end of the year.
Yeah, unbelievable.
What does that tell you?
Yeah, I think generally
quantitative easing.
Yeah.
What does that tell you?
Well, when you look back at what the QE programs did do, they provided liquidity to the system, and I think that's what's happening again here. In that environment, people were really kind of pushed out the risk spectrum, so they went after more riskier assets. They had the liquidity to do so, and I think we're going to get a little bit of a repeat of that. Even though they're not calling it QE, the impacts may be the same. Right.
And you mentioned gold.
Yeah.
I'm watching gold as well. A lot of folks think gold really could be poised to break out in 2020. Are you in that camp, and to what extent?
We've liked gold this year a lot. Given what's happening globally with negative yielding debt, with central banks in easing mode, gold becomes a safe haven asset in that environment. We may not see the same run we've had this year next year, just because the central bank easing may be towards its end, but we continue to like it as a flight to safety asset class, and also something that's less correlated to traditional equities and fixed income.
And what are your thoughts on the economic data? I mean, we had that blowout jobs report on Friday. Wasn't that a beauty? I love it. I absolutely love it. And the revisions to the prior 2 months upwards. So that was good news as well. What are you making of the economic data? I mean, there's a feeling of bottoming, right?
Yes, there certainly is. I would still say there's a dichotomy in the U.S. economy, and it's the consumer continues to do well. Jobs data is indicative of that. But on the other hand, you have the manufacturing side. So PMIs are still soft, still sub 50. We'd like to see a bottoming in that, a more clear bottoming, especially when you look at business investment. That's really what comes out of it. So if those two things stabilize, the consumer continues to remain strong, we're set up nicely for a refresh in 2020.
Right. And when you talk about the barbell approach for equities, do you basically have something very risky on one side and something safer on the other? I mean, what is the pair?
Yeah, absolutely. So I think, on one hand of that barbell from a sector perspective, we continue to like technology here. We think disruptive technology in particular, areas like cybersecurity, mobile payments, AI, robotics, they have long-term secular growth stories. They do well in lower growth, lower rate environments. So we continue to feel that that's a place to be for long-term investors. But we'd like to barbell that a little bit. Now we don't favor the defensives as much, but we'd like to rotate from defensive to cyclical sectors, so financials and industrials, and even parts of healthcare that have lagged.
Right. Any thoughts on energy at all? Some people are also thinking that energy might be a good one for 2020.
Yeah.
I don't know.
Yeah, you know, it's been disappointing this year. I think it's the worst
performing.
It's been
disappointing for the past decade.
Yes.
Sorry to interrupt.
Yes. No, absolutely. And, you know,
yeah.
despite the fact oil prices, the underlying oil prices have increased, the stocks have lagged. So I do think for those looking for yield, they have great yields. You have to go with high quality balance sheet, you know, strong balance sheet players. But I think there are select opportunities, energy. But as we said, we like the other sectors a little better right now.
Yeah. Great to see you.
Great to see you. Thanks for having me.
Yeah, I like the optimism too. It's a pleasure. Mona Mahajan, U.S. investment strategist at Allianz Global Investors.